Welcome to our in-depth market update, where we dissect the forces shaping your investments both domestically and globally. Today, we confront a fascinating dichotomy: the roaring resilience of the Indian market against a backdrop of global macro uncertainty, punctuated by critical Fed decisions and shifting geopolitical sands. We have breaking news on India's market performance, a deep dive into RBI policy, and an exclusive look at how FII and DII flows are influencing sentiment. Globally, all eyes are on the Federal Reserve, with the highly anticipated debut of Governor Warsh and the ripple effects across Wall Street and commodity markets. We'll also bring you a segment on specific corporate movers and shakers, analyzing why individual stocks are making headlines. First, let's turn our gaze to the Indian subcontinent, where the Nifty and Sensex have demonstrated remarkable resilience, defying global headwinds. The Nifty 50, in particular, has seen a steady climb, approaching new all-time highs, propelled by robust domestic consumption and infrastructure spending. The Sensex mirrors this bullish trend, with broad-based gains seen across key sectors like financials, automobiles, and real estate. This performance is largely attributed to India's strong economic fundamentals, a burgeoning middle class, and a proactive government policy environment that continues to foster growth. Market analysts point to sustained corporate earnings growth and positive forward guidance as crucial drivers sustaining this upward momentum. Central to India's stability is the Reserve Bank of India's measured approach to monetary policy. The RBI has maintained a cautious stance, keeping interest rates steady for several consecutive meetings. Their primary focus remains on managing inflationary pressures, which have shown signs of moderating but require continued vigilance. Governor Das recently reaffirmed the central bank's commitment to achieving the medium-term inflation target while ensuring adequate liquidity to support economic growth. This stable policy environment has also contributed to the Indian rupee, or INR, showing relative strength against the US dollar, largely due to capital inflows and a narrowing trade deficit, making Indian assets more attractive to global investors. Examining investment flows, we see a fascinating dynamic. Foreign institutional investors, or FIIs, have shown renewed interest in Indian equities, reversing earlier outflows and contributing to the market's ascent. However, the true bedrock of this rally has been the consistent and robust support from domestic institutional investors, or DIIs, particularly through mutual funds and pension schemes. This strong domestic participation has acted as a crucial buffer against any potential global volatility. On the corporate front, India's auto sector has been a standout, reporting strong sales figures driven by festive demand and new model launches, while the IT services sector faces some short-term headwinds from global demand slowdowns, though long-term outlook remains positive. Shifting our focus globally, the financial world has been keenly awaiting the Federal Reserve's latest decision, especially with Governor Warsh making his debut. Stocks and the dollar edged up ahead of his initial remarks, reflecting market hopes for clarity and a potentially less hawkish tone. All eyes were on whether Warsh would dial back the Fed's transparency, a concern that has been floating through the markets. The broader expectation was that the Fed would hold rates steady, emphasizing a data-dependent approach. However, any deviation from this expectation, particularly concerning the future path of interest rates or the pace of quantitative tightening, could have significant implications for global liquidity and investor sentiment. This period remains fraught with anticipation as markets digest every syllable from the Fed. Beyond central bank policy, recent data on consumer health and employment paints a mixed global picture. May retail sales received a boost from credit cards and tax refunds, indicating that consumer spending, a crucial economic driver, is holding up. However, a recent ADP survey reveals a concerning trend: less than one-third of global workers feel their jobs are safe. This sentiment, particularly prevalent in developed economies, highlights underlying anxieties about economic stability and potential layoffs. This divergence between strong retail sales and job security concerns suggests a consumer base that, while currently spending, remains highly sensitive to economic shifts, which could impact future spending patterns and overall market stability. Now, let's talk corporate heavyweights and the technology sector. Jim Cramer has been vocal about the titans of AI. He unequivocally states his favorite is NVIDIA, acknowledging its undisputed leadership in AI acceleration, but adds that AMD is fantastic, noting its competitive advancements in both GPUs and CPUs, which are critical for the AI ecosystem. Furthermore, Cramer makes an easy call to buy Dell, expressing strong belief in Michael Dell's vision and the company's strategic positioning, especially in server infrastructure for AI. These companies are not just riding the AI wave, they are building the infrastructure that powers it, making them compelling plays for long-term growth despite market volatility. In other significant corporate news, SpaceX had the biggest IPO in history, a testament to the insatiable demand for space exploration and satellite internet. However, Jim Cramer cautions that while the long-term upside is conceivably unfathomable, the stock is still pretty darn expensive, even compared to Rocket Lab. This reflects a common dilemma: incredible potential versus already lofty valuations. Separately, used car retailer CarMax saw its shares fall after reporting earnings beats, with the CEO detailing a turnaround plan. The market reacted negatively to the details of the plan, suggesting investors are skeptical of the pace of recovery in a challenging used car market, highlighting the pressure on traditional retail models. Turning our attention to geopolitics and its impact on commodities, the Strait of Hormuz has been a significant focal point. The threat level has reportedly been downgraded after an Iran deal, with President Trump stating that the agreement is to be signed tomorrow or Friday. This development has already seen the oil industry making tentative moves to capitalize on the easing tensions. Dark oil tanker transits are keeping oil flowing through Hormuz ahead of this peace deal, signaling a return to more normalized shipping routes. Even corn ships are crossing Hormuz toward Iran and the UAE, anticipating the deal, which underscores the immediate and broad economic implications of improved regional stability. Despite the easing tensions in Hormuz, the global oil market faces complex dynamics. U.S. oil stockpiles have fallen to critical lows as war spurs exports, creating upward pressure on prices. Simultaneously, Russian gasoline prices are skyrocketing due to Ukraine's strikes on refineries, further disrupting global supply chains and exacerbating energy insecurity. This confluence of factors means that even with a more stable Hormuz, the underlying supply-demand imbalance remains acute. In the metals market, copper miner Antofagasta is seeking to link ore sales to the spot market, a strategic move to better capture fluctuating prices and potentially increase revenue in a volatile but critically important industrial commodity market. On Wall Street, we are witnessing some significant shifts. Banks are reviving risky loan deals that they previously struggled to sell, signaling a renewed appetite for higher yield, higher risk assets in a search for returns. This development could indicate a return to pre-crisis lending practices, warranting close monitoring. Culturally, there's talk of operar dia y noche, or operating day and night, as Wall Street contemplates changes that could lead to extended or even 24/7 trading, fundamentally altering the rhythm of global finance. Such a shift would have profound implications for market liquidity, investor behavior and the very nature of financial markets, pushing the boundaries of traditional trading hours and accessibility. Finally, we cannot overlook India's largest bourse, the NSE, filing draft papers for a landmark IPO. This move by the National Stock Exchange of India is said to be a significant event for global capital markets, offering investors a direct stake in the country's thriving financial infrastructure. An IPO of this magnitude will attract considerable attention, further integrating India into the global financial ecosystem and providing a benchmark for other emerging market exchanges. This also comes at a time when Braven Howard is preparing to start backing external stocks traders, indicative of a broader trend among sophisticated institutional investors to seek alpha in diverse and often less traditional avenues, including through external talent. As we conclude, the global economic narrative is one of careful navigation through both immense opportunity and significant risk. India stands out as a beacon of domestic strength, with prudent policy and strong internal demand driving its markets forward. Meanwhile, global investors grapple with an evolving Fed stance, the complex interplay of geopolitics on commodity prices, and the innovative yet volatile landscape of big tech and high-growth companies. Staying informed, adaptable, and disciplined in your investment strategy is more critical than ever. Thank you for joining us for this in-depth market analysis.